Global markets shifted significantly today as approximately $140 billion worth of capital moved across asset classes, marking a notable reallocation cycle rather than panic-driven sell-offs. Bitcoin dipped intraday toward $115,000. Trading resumed higher, near $118,000, reflecting resilience amid uncertainty. Ethereum experienced larger intraday price swings, briefly falling below $3,600 before rebounding as liquidation pressure dissipated. Equity indices saw modest mixed results, with the S&P 500 reaching new record highs while tech stocks pulled back slightly. Commodities also responded dynamically, with gold rallying as a safe haven and crude oil slipping amid demand concerns. Crypto market participants displayed calm amidst volatility, with Bitcoin bouncing from critical support and Ethereum showing signs of controlled consolidation. Despite regulatory uncertainty around the Bitwise and other crypto ETF approvals, institutional flows into spot Bitcoin vehicles remain substantial. On-chain data reveals whale accumulation below $115,000, suggesting deep-pocketed traders view current prices as accumulation zones. The recent U.S. legislative draft aims to define ancillary crypto assets and clarify bank usage of distributed ledgers, which could pave the way for institutional involvement. However, altcoins such as XRP, Solana, and Dogecoin experience sharper pullbacks, indicating selective investor caution and rotation toward top-cap assets. Equities showed a bifurcated trend as investors responded to mixed corporate earnings. Coca-Cola reported better-than-expected consumer spending trends, while General Motors faced headwinds from escalating tariffs, slashing its profits unexpectedly. Meanwhile, tech sector names, especially semiconductor and cloud computing firms, saw profit-taking ahead of another major earnings batch. The Nasdaq slightly corrected, snapping its record high streak amid profit booking and bond yield sensitivity. Investors appear to be rotating from growth toward defensive sectors, seeking stability as macro risks increase. Treasury bonds witnessed notable moves with the 10-year U.S. yield climbing back above 4.3%, reflecting renewed inflation concerns and persistent rate expectations from the Federal Reserve. This yield action exerted pressure on rate-sensitive equities, yet sustained demand in the bond space suggests cautious investor behavior. Mortgage rates were impacted, inching higher, while corporate bond issuance continued smoothly within credit spreads. Agency bond flow remained consistent, signaling no panic on credit stress. These dynamics hint that monetary policy expectations are a key driver of cross-asset positioning. Commodity markets provided contrasting signals. Gold surged by nearly 2% as flight-to-safety flows emerged amid global unease. Oil prices retreated close to $70 per barrel, impacted by revised demand forecasts as OPEC maintained current output levels. Industrial metals such as copper and nickel fluctuated softly, reflecting underlying manufacturing slowdowns. These diverging performance patterns reflect heterogeneous investor sentiment across sectors. All told, commodity markets highlighted strategic asset rotation rather than panic selling. Asia-Pacific markets demonstrated mixed sentiment. Japan's yen strengthened over 1% amid heightened geopolitical tension and BOJ speculation. Singapore's Straits Times Index posted an 11-day win streak, highlighting pockets of investor optimism despite global headwinds. China's Q2 GDP growth exceeded expectations at 5.2% year-over-year, yet property sector stress remained pronounced, requiring careful sector allocation. Export control issues from South Korea also rattled tech supply chains. These regional nuances point to variability in sentiment and capital flow across Asia. In Europe, indices pulled marginally lower as recession fears and energy cost concerns prompted cautionary rotation. German DAX and French CAC indices slipped several percentage points after commodity price signals softened. Eurozone bond yields rose amid inflation persistence, increasing pressure on regional central banks. Political sensitivity around new U.S. tariffs also contributed to market uncertainty. Investors are actively balancing growth and stability exposure within European allocation strategies, The U.S. Senate Banking Committee circulated a draft bill aiming to formalize crypto market structure, extending SEC and CFTC definitions and clarifying bank usage of digital assets. This legislative push follows the House-passed CLARITY Act and affirms growing institutional engagement with digital infrastructure. While crypto equities like Circle, CRCL, declined over 8% after a downgrade, Bitcoin and Ethereum briefly surged on optimism over regulatory clarity. The proposed legislation could catalyze mainstream adoption, though stakeholder feedback remains in process. Markets view this as a structured pathway to legitimacy, rather than heavy-handed control. In the institutional space, companies such as Bitmine and the Ether Machine disclose significant crypto treasury accumulation strategies. Bitmine has reportedly amassed over $1 billion in Ethereum, backed by major investors like Cathie Wood and Peter Thiel. These strategies reflect growing belief in Ethereum's role in yield generation via staking. Spot Bitcoin ETFs have seen net inflows, although short-term outflows were noted ahead of Powell's speech. Corporate balance sheets are increasingly embedding crypto as strategic reserve assets, signaling structural realignment in treasury management. Market sentiment showed cooling in volatility measures, with the CBOE VIX rising modestly but remaining below panic thresholds. Crypto liquidation events reached $300 million within 4 hours, driven by Ethereum's dip below $3,600 and Bitcoin's test of $115,000, yet recovery momentum quickly ensued. Analysts emphasize that volatility action is now being managed by disciplined market players utilizing hedging instruments. Retail investor interest remains high, but many are positioned conditionally with emphasis on key trigger zones. The collective behavior signals shifting from speculative euphoria to selective engagement. Central bank signals remained in focus. Powell's recent remarks and upcoming commentary are weighing heavily on risk sentiment. Meanwhile, President Trump's criticism of Fed policy intensified political pressure on the central bank, raising renewed debate over interest rate decisions. The dollar index softened slightly in response, adding complexity to foreign currency and commodity pricing. Global investors remain sensitive to the interplay between monetary policy and geopolitical intervention. This evolving narrative underscores the importance of forward-looking policy analysis in asset allocation. Corporate earnings continue to shape market tone, with various sectors displaying differentiated strength. Defense contractor Lockheed Martin tumbled roughly 11% following margin pressures and contract delays, while Coca-Cola's steady consumer spending lifted share prices. Meanwhile, Equinix benefited from activist investor involvement, reflecting investor appetite for pragmatic asset reallocation. OpenAI and SoftBank announced a pause in near-term AI investments, implying cost caution within the tech sector. Such heterogeneity confirms that earnings remain a dominant force behind capital rotation today. Trade policy remains a key risk vector. New U.S. tariffs on the Philippines, Indonesia, and potentially Europe cast a shadow on trade flows. Companies with global supply chains are adjusting pricing models and hedging strategies as tariffs approach implementation. Talks between the U.S. and China, including potential Trump-Xi meetings, will be critical to restoring stability in cross-border commerce. Investor sentiment is hedging on pending agreements rather than immediate outcomes. Trade remains a macro pivot around which global markets turn. Venture capital activity remains subdued as macro uncertainty persists. Biotech, fintech, and tech startups are experiencing valuation pressure, resulting in smaller rounds and increased focus on profitability. The drop in speculative funding contrasts sharply with growth seen earlier in the year, reinforcing caution. Investors are seeking clearer paths to liquidity and returns before recommitting to high-risk sectors. This slowdown is a precautionary measure expected to support sustainability once stability returns. Real estate indicators flagged slowdown in the housing market, with new building starts and mortgage applications trending downward. Elevated yields and affordability challenges are tempering new construction and home purchases. Nonetheless, housing inventory levels remain tight in some regions, limiting downside. Builders are adjusting project pacing but not halting activity across major markets. The sector's recalibration is reflective of prudent investor positioning amid uncertainty. Currency markets show distinctive trends overseas. The yen's rally increased pressure on the Bank of Japan, while the euro held stable against a firmer dollar. Emerging market currencies fluctuated narrowly amid cautious capital flows and central bank interventions. Currency-based assets are being realigned cautiously, with capital allocations taking cues from Fed signals and global policy divergence. FX remains a crucial component of today's broader risk calculations. Investor positioning in ETFs continues to evolve as product innovation accelerates. U.S. ETF assets now exceed $11.6 trillion, with significant growth observed in crypto-linked and actively managed segments. Despite broader market volatility, investors are leveraging thematic ETFs, ranging from AI exposure to managed futures to tailor risk returns. This ETF proliferation allows finer granularity in portfolio construction. It points to structural transformation in institutional access to diversified exposure. Commodity-linked investment strategies followed suit as well, with renewable energy and gold-themed ETFs outperforming during the shift. Oil exposure was dialed back slightly, while currencies like AUD and CAD faced pressure from soft commodity pricing. Positioning within raw materials is being adjusted toward defensively biased portfolios. Commodity sentiment is evolving alongside economic rotation rather than move-based reflexes. Strategic tweener positioning is taking precedence. Market psychology reveals caution balanced by opportunity. The Fear and Greed Index remains neutral, while conviction-driven sentiment signals selective risk-taking. Technical indicators show bullish patterns forming around key support zones like $115,000 for Bitcoin and $3,600 for Ethereum. Equity uptrends in S&P reaching 6,325 levels show market resilience. Investors are favoring measured entry over impulsive moves. This mindset reflects maturation in global capital behavior. To conclude, today's $140 billion asset rotation constitutes strategic repositioning from risk-on to adaptive balance, setting the stage for renewed opportunity. Fundamentals remain intact across sectors, and macro signals are being digested progressively. Active management and diversified exposure now offer the best pathway forward. As volatility subsides into recalibration, disciplined investors can secure advantage. Stand ready. Tomorrow can be your market moment.